Hi, I'm AJ Stockwell. I'm the founder of Climb CFO, which provides fractional CFO services for direct-to-consumer e-commerce brands. In this video, I'm going to talk about how to account for a merchant cash advance loan, like from Clearco, Shopify Capital, PayPal, etc. These loans can be a little bit tricky to account for, especially the financing fee or interest portion. This is because the interest is often a fixed amount. It's usually stated as a flat fee to borrow, but the term of the loan is a little bit uncertain because you aren't quite sure how fast it will be paid back. This is because it's paid back through a portion of a merchant's credit card processing. So Clearco might extend you $100,000 of capital to use, and they'll charge a flat 10% fee, and then they will sweep 12% or 10% or some percentage of your daily sales and credit card processing in order to pay down that loan. The higher your sales are in a given period, the faster you might pay down a loan. Because of this, it's sort of hard to calculate the cost of capital here, but in my experience, these companies are usually aiming for it to be about an effective 14% interest rate or so if you were to annualize it. Let's go over to QuickBooks and talk about how to account for it there. So I have this brand new QuickBooks Online account set up. And the first thing that we need to do is set up a few new accounts in our chart of accounts. Now, in our chart of accounts, the first account that I want to set up is going to be a liability account. It's going to be an other current liability. I'll choose the detail type as just loan payable, and I'm going to call this Clearco loan. Now I'm going to create two sub-accounts under that. The first one is going to be called Clearco Advance, and we could add a description for it. Also, since this is a brand new QuickBooks account, I didn't yet turn on account numbers for the chart of accounts, but that is a function that I usually like to use. Then the third account that we want to set up, again, a sub-account of Clearco Loan, and that's going to be called Clearco Fee. Now I'll save and close that, and if we look through our chart of accounts, we see those three accounts here. Now we need to record having received the advance from Clearco. And for Clearco specifically, they will actually issue you a debit card, or it might just be a virtual debit card. But either way, they're not depositing funds into your checking account like Shopify Capital or PayPal might. So what I'm going to do is create a new account, and it's going to be a bank type of account. For QuickBooks purposes, I'll just indicate checking, and I'll call it Clearco Card. Otherwise, we would just have the deposit go into our main checking account. I'll go ahead and save this, and now we want to record getting those funds. Now, the reason that I set up those other accounts is because Clearco will include the fee in your original balance, even though you might only receive the loan amount that was indicated. So what I mean by that is you might be offered a loan of $100,000 with a $10,000 fee. You'll get $100,000, but your balance to pay down from the very beginning will be $110,000. The way that we reflect this is we go to New Transaction and choose Bank Deposit. I want to indicate that these funds are going onto our Clearco card. Again, if you're using PayPal or Shopify, it might just be going right into your main checking account. I will say the funds are coming from Clearco, who I need to set up as a new vendor. I'm not going to add other details just for the sake of going quickly here. We indicate the date, and then the account for this row, we want to use Clearco Advance. And for this, I'm going to indicate $110,000. So that includes both the fee and the original loan. Then I'm going to enter a second row, and this is going to be Clearco Fee, and I'll subtract $10,000. What this is effectively indicating is that we are receiving $100,000 to use. Our loan balance is $110,000, but we've sort of prepaid the $10,000 fee because our balance is $110,000, but we only got $100,000. I'm going to go ahead and save and close out of here. And then I'm going to toggle over to a balance sheet, which I already had open. And I'll go ahead and refresh this. Now what we see is that we have access to $100,000 in capital, and we owe $110,000 to Clearco. We have this negative liability amount. You can sort of think of this negative liability as a prepaid expense, as though it were up in the assets section, but we want it to net against the advance to basically indicate how much we actually received. Now what happens is as your sales are processed, whether that's on Shopify or with someone else, Clearco is going to sweep a portion of those funds to pay down the advance. Now the big question is, how do we account for the actual fee? Because right now, if we look over at the P&L, there is no activity because we haven't actually recognized any of that financing cost. There are a couple of ways to do this. One is to effectively just match the payments with amortizing the fee. So if $11,000 is paid back towards the Clearco advance, we might split $10,000 of that among the principal portion and $1,000 among the fee. This isn't exactly perfect, but again, because of the uncertain term of the loan, it's really hard to match up the exact financing timing. So I'm going to use that method of recognizing the fee, expensing this sort of prepaid fee over the period of time that we pay back the loan. So let's say that we had however much in sales for a given month, and Clearco has swept $11,000 to pay down the loan. So I'm using the expense type of transaction. We'll say this is being swept from our main checking account, which right now doesn't have a balance, but that's okay. We can record this way. We want to be paying down the Clearco advance because that is the main loan account that indicates that we owe $110,000. So I'm going to indicate $11,000 was swept there, and I'll save and close. Now our loan balance is going to be $99,000 according to their statement because it started as that $110,000. But we now also want to amortize a portion of that fee, or basically recognize that we are expensing it. So I'm going to enter a journal entry for that same date. And the expense account that I use for this is interest expense because this is effectively an interest fee. They might not call it that, but that's effectively what it is. And then the offset is the Clearco fee. So debiting an expense means we're increasing or posting an expense. And when we credit a liability account, we're increasing the balance of that account. Remember that this account started out as negative, so this is going to bring it from minus $10,000 to minus $9,000. What this shows now is that we still owe them $99,000, including the financing fee, but we've effectively paid down about 10% of it. Looking over at the P&L, and I'll go ahead and refresh this now, we see that we have $1,000 of interest expense recognized. Now let's look side by side at these next 10 months to see how this actually amortizes over time. Here you see that we've posted $1,000 of interest expense per month, and at the end of this assumed 10-month term, we have the full $10,000 of fee recognized. Looking at the balance sheet, we similarly see $11,000 per month being swept to pay down the advance, which started at $110,000, until we get to that last month in April when the final $11,000 payment is made and the final $1,000 of prepaid financing fee is moved to interest expense. This is the process of accounting for a merchant cash advance in QuickBooks Online.